All right, welcome to the 80/20 Rockstars Podcast, episode 4. Today we've got the one, the only Gary Jonas with the How Group. Welcome.
Thank you for having me, Rodney.
Thank you so much for joining me. I've been very, very, very much looking forward to this conversation. You're like an urban legend, I feel like, in Philly, as a guy who's started from, the beginning, single families, and you've grown a lot. So, let's jump right into it if you can. I'd like to get into, if you can just, I feel like I've known a ton about you because I've been following you over the years, but if you can just give us just a synopsis, like a little bit of background, where you came from, how you got into real estate investing. That's what I want to focus on for most of this episode, like particularly real estate investing, development. I know you've got a team and all sorts of businesses. So if you go a little bit into that, please.
Sure. So, I'm a born and raised Philly guy. Grew up in the Roxborough area and then went to 16 years of Catholic school in the Philadelphia area. And when I graduated from college, I ended up in the finance business kind of purely by accident. Started doing mortgages for people, that kind of stuff. And, through that process, what I discovered, one of the great things about doing mortgages for people is you kind of see their whole financial history. Put everything in front of you. Here's my assets. Here's where my income comes from. And so, when you do a lot of that, you get to see, well, how are people really creating real wealth? And what we realized is that people that own real estate were kind of creating the most wealth of anybody we saw. So it was kind of counterintuitive to what we learned. Like, hey, go to school, and be a doctor or a lawyer, and you're going to make a lot of money, and that's going to make you rich. And it's like,
yeah,
what we discovered is that really it was the people that understood how money worked and the people who owned real estate that were getting the best results. And so, I was working for a mortgage company. I got the opportunity with a couple partners to try and start our own mortgage company. We did that. And through that process, we decided, well, let's go out and start trying to buy some real estate ourselves. And so we took my partner, Andy, who was the best of us construction wise, and said, hey, why don't you focus on trying to build some retirement for us through real estate? And he went out and started buying properties and fixing them up. And what we discovered is, look, this is working, number one. And number two, he's really good at the construction piece of it.
Mm-hmm.
Let's bring one of the other ones of us in and let that person focus on, finding the properties, renting the properties, doing that other stuff. And so that was me. I got nominated to go in and buy the real estate.
And Andy was a partner in the mortgage company as well?
Gotcha. That's correct, Rodney. So there were 4 of us that were partners, and Andy was one of the partners, and we sent him out to start buying real estate. And when that started doing well, then we sent me in as well. And then so the 2 of us were out there. I was finding properties, putting financing together, renting the units, and he was handling the construction and maintenance and that kind of stuff.
Awesome. Now I know a little bit about how your original plan, your original goal for how many properties you're going to buy and how that was going to set you up for your life. Can you just talk about that for a second?
Yeah. So one of the things that happened for me was along the time that I was looking at all these applications and seeing all these things, I also read the book Rich Dad, Poor Dad for the first time, and really starting to understand a little bit more about real estate and kind of how the financial aspect of it works. And so in reading that, I was like, all right, well, I want income producing assets, and, how am I going to make this work? And so I had set a goal, which is, look, I have a full-time job doing this mortgage stuff. I'm going to buy 1 property a year for 10 years. And every dime I make, I'm going to use to pay off the mortgages. And hopefully in 15 years, I'll be able to pay all of these properties off. And that'll give me the cash flow I need to live. And, I started in that process when I was 30. So I figured by the time I'm 45, I'll be ready to retire and I'll have the income I want from my real estate. And that was kind of what I put out there as a goal for myself. And ironically, Rodney, that was prior to us sending Andy out to buy real estate. So it was like, hey, we all had this mortgage thing, and I was just buying properties in Roxborough, because that's where I grew up. In that market, obviously, in hindsight, that was a great place to buy, 20 years ago.
Okay. So And I love diving into this because this relates to exactly what we're going through right now. Like, and when I say relates, it's like we just finished our QuickBooks for doing our taxes this year, and guess what I realized for a lot of these single families that we own? Like, guess what ate us up? The maintenance. And I'm like, and so because I've been investing with my partner Steph for like 4 years, and so because I'd heard you say this years ago in another podcast, and the reason that you stopped doing that was because single families don't really cash flow enough most of the time, which is it's like a really tough truth. And so at what point did you start, like, did you already have a handful of them before you realized that? And it's like, all right, maybe they're going up in value, but I'm not really like seeing what I want to be seeing here, or.
So it's a great question. I would tell you that I had 10 properties.
Yeah.
Right. And I had bought them really well, and the values had gone up and rents had gone up, and all of these things were working in my favor. But I had a full-time job. So at 10 properties, I was really struggling, to have young kids and, run my full-time job and manage these 10 properties. So I hired like a property manager. There was just a lady that I knew from the neighborhood that was doing the books and renting the apartments.
Yeah.
And, I would get the statement every month, and I would look at it and go, how do we not make any money this month? And, again, to your point, what happens is I buy a property and I go, oh, my rent's $1,500 a month. My mortgage payment's $1,000 a month. I'm making $500 a month. But, 1 month worth of vacancy, hey, a little bit of maintenance, paying the property manager, paying the fees that you have to pay to the city every year. And all of a sudden you add all that up, and that $500 is really $50 a month. Right. And so as soon as I started realizing that, I was like, man, this is depressing, but don't worry, because I'm going to pay off these properties, and then I'm really going to have cash flow. And so I got to the point where I paid off my first property, and I'm like, now I'm here, man. I finally made it. We're in good shape.
Right.
And I went in to kind of re-rent the property. And I looked at it and I went, man, I got to spend about 50 grand in here to get this up to the standards that I wanted to be at. And then I went, well, what am I going to do? I'm going to put the 50 grand in. And then I know my philosophy. I'm going to try and pay that 50 grand off as soon as possible. And I'm never going to create any cash flow in these properties because I'm always trying to pay off debt.
Yeah.
So the nice thing about, bigger multifamily projects is they're always underwritten by the bank in all of those places with real expenses, 35, 40% to run the buildings. And so once I realized that, I sold everything that I owned and invested it in one of the real estate groups, or one of the real estate deals we were doing as a group at that point. And guess what? Now every quarter I get a check from that property, and it's wonderful.
You're speaking to me right now. So before we get up to present and like and your portfolio now and things you're doing, like, what would you say to, I'm literally exactly where you're at. Like, we've sold off some, but like, call it a dozen 1 to 4 unit buildings. And I know, by the way, more than a few investors that I can think of off the top of my head are kind of in the same spot. Like, our area's been West Philly. It's happened to appreciate pretty well, right? 1I-104, 1I-143. It's been pretty strong these past couple of years. But the same thing's happening. Like, I'm looking at our statements. I'm like you said, this is rented for $1,300 a month, $1,350 a month, or 2 units. I'm getting 1,000, 1,200. But then the AC unit had to be serviced, and then, oh my God, the roof guy didn't do a good job, and we had to spend $1,500. And then end of the year, we're breaking even. And I'm like, I'm sitting in it, just like you were saying, like, I'm sitting at this point where I'm like, I know that we're going to wake up one day and have a decent amount of equity. And we're already doing 100 times better than 10 years ago when I didn't even know about investing. But like, just, it's not going to happen fast enough. And I'm struggling with, like, what do I do? Like, it's a weird point in the market, which, I have plenty of questions about that too. But I'm like, should someone, do you have any I know it's tough to give general advice, but like, you think at this in 2021, if someone's going through similar issues, like, is it a time to consider selling all your portfolio, pulling all your equity back out, and trying to go after a multifamily? Or any thoughts on that?
I always have thoughts, right? Here's the good news. Good news, you have me on the show. I have tons of opinions, right? So to answer your particular question, if somebody were to ask me that question, I would sit down and go, okay, we really got to understand what your goals are. Because Rodney, if you tell me, hey, look, in 10 years, my plan is to liquidate my real estate portfolio and move to the beach somewhere, and I don't want to talk to anybody, I might say, well, continue down your single family strategy. Typically, they appreciate a little faster, and they're more liquid than the commercial real estate. In my opinion, there's a bigger buyer pool for them, right? You see what's going on with values right now in residential real estate. So, values in commercial real estate are doing good too, but not to the level that you're seeing the increases in the residential right now. So if it were me and that were my goal, then I would stay in the residential stuff. If the goal was more in line with kind of my goal, which is I want mailbox money, I want checks coming in every month, right? Then I would probably consider selling, because you're getting huge appreciation right now on those assets, and you can buy into a multifamily building that will create cash flow.
Right.
So, if you were to think about it from a cash flow standpoint and say, okay, well, right now, and I'm just going to make up math to make it simple, I have $1 million in equity in the 10 or 12 properties that we own or whatever it is, because West Philly has done tremendous. So you guys picked a great market, right? And now I'm going to, what's my return on that $1 million in equity, right?
Right.
So that's the question you ask yourself. And I find that I have two rules of thumb on that. Okay. And the first is, if I can cash out over 16 times whatever I actually really make in a year, now I'm starting to consider reinvesting that money into something else. Okay. The other way to look at it that might be a little simpler, right? Commercial guys work off of cap rates, right? So if, smaller multifamily deals are trading in the 5.5% cap rate range right now. So if you were to look at your equity and you were to say, well, I got $1 million in equity, but my properties only make $30,000 a year, right? Well, you're making 3% on that equity. So now if you can go out and take that money and invest it in something that's making 5%,
right?
Well, you've almost doubled your cash flow, right? And the other thing is you're going to be able to take that $1 million in equity, right? And you're going to be able to put that as 25% down, or let's just make it 20% down. So you're going to buy $4 million in real estate with your, because it's stabilized real estate, and you're going to get a loan that's at, low threes right now. And so you're probably going to pick up a little bit of extra income on the fact that your interest rate's lower than the 5% that the deal makes, or 5.5%. So all of a sudden you're gonna create some leverage there too. So, it's a little more complicated than that, but at the highest level, if you were to just look at making 3% on my money now, I think I can invest it in something that's going to make 5. Okay, that's that clearly seems like that would make sense, right?
Okay, that's super helpful, and I think that's going to help a lot of people at least start the gears going to do that simple math. Because as much as I know those terms and all that, I sometimes forget to think about it in the simplest way. Like, when's the last? It's been a little while since I put everything we had in the spreadsheet and then figure out if I sell this right now, how much are we going to walk away with, and then what are we? I already know what we're really making, but I think we're definitely going to be doing that. So thank you. And so to backtrack for a second, just so people understand where you're coming from, can you tell us about what your business looks like? You started with owning, 10 or so single families, you sold them off, then you started to just go a little bit bigger. What has that grown into, and what does your business look like today?
Well, I love that you let me brag about myself, Rodney. So that's good news. So today we have just about 1,000 units that we own. And we have grown to the point where we have our own property management company, our own construction company. We still have the mortgage company, which is kind of where we originally started. And then, we also have a real estate group. So
and by real estate group, you mean a sales group for people listening?
we have, yes, I'm sorry. We have a real estate group that sells the townhouses and stuff that we build, helps us try and identify properties that we buy, and just does residential outsale stuff. So one of the things that we try and do as a competitive advantage, because we love real estate so much, right? We're on here talking about people owning real estate, and then we have 1,000 tenants, right?
Yeah.
Or 1,000 units, which might mean we have 1,500 or 1,800 tenants. And it's our belief that those 1,800 tenants should want to be homeowners or real estate investment owners. So one of the things that we do is we have a program for our tenants where we give them a portion of their rent towards down payment on houses if they want to buy, right? And we want that path to be there for everybody. So, that was one of the reasons we have our real estate group, which is kind of sell our stuff, help our tenants, and then just help all our friends and family. And we have roughly 100 employees now, and all those people have real estate needs. So we should have those services, right? So we kind of call ourselves a one-stop shop for maximizing real estate potential, right? Like, if you came to me and said, hey, I'm ready to make the next step, but I don't need any money, Gary. I just need a construction group to help me build it. And I've never done this before. Well, no problem, Rodney. We can help you with that. Or if you said, well, no, I need somebody to sign on a debt with me that has a little bigger balance sheet and do the construction and manage the property, no problem. I can do that. Right. So it gives us the ability, and I love this about our company, to not have to sell anybody anything. It's just, you tell me what your need is within the real estate space here, and we can help you.
Yeah. As simple as that. I mean, and that's freaking awesome. I didn't know about that. That's a really cool idea about the tenant program, because you're promoting home ownership. And I'm sure, obviously not everybody's going to take advantage of it, but that's a very tangible way to give back. A lot of people talk about giving back and have programs and do events and all that, but that's a tangible way, because I'm sure you're telling someone, I don't know what the details of that program, but I would imagine if someone's renting for you over like a 5-year period, and say they start with bad credit and all that, and they're like, hey, I want to buy a house eventually, and you can show them a path. You're paying me $1,200 a month for 5 years. We'll put a portion of that aside, and you can go buy your own little house and keep the same quality of living. And, you could buy a similar house for $1,000 a month payment or whatnot, right? Those are the conversations you're having with people?
Those are exactly the conversations we're having with people. And, they don't have to be there 5 years. They can be there a year, right? Like it depends on, like, everybody's different, but the idea is you can't preach owning real estate and then not make it available to the people that are helping you with your real estate.
Right.
No. So that goes with inside our company. Like, we're trying to push everybody in our company towards financial literacy, towards owning real estate. And we're trying to do that with our tenants and our vendors and everybody. So if you're our HVAC guy and you're like, well, I'd like to own real estate, well, it's no problem. You can invest money in our deals. We'll work with you. Everybody should own real estate, and there's a lot of different ways to do it.
That's awesome. So there's so many different directions I go here. Of the portfolio that you have right now, first of all, are you doing these days, like, the market is pretty competitive, right? And I know, or historically, you've been mostly in the Philly market in the suburbs. It's competitive. It's extremely competitive in Philly for ground up construction. Costs are through the roof. Like, everyone's trying to sell properties near center city for like 4 caps when they're not really worth that much. So are you doing a lot of, like, right now, first of all, are you like finding any products at all, or is it really sparse? And then are you doing for sale, for rent? Can you give me a little picture about what that looks like? Because I'm very curious to know, like, so on your scale, like, and you're looking at very different deals than we're looking at. And I've gone off of a couple conversations where I've heard people say, like, some people have just completely stopped and not buying anything until I know what's going to happen with the cost of wood. But then some people that are still going on and getting things entitled and zoned and expecting things to maybe be different in a year from now or more reasonable.
Yeah, right. So tons of different approaches to the same problem, right? And, to me, nobody knows what the right answer is, but here's what we do know, right? In real estate, you got to protect your downside. So how do you do that, right? How do you do that? It's our belief that it's very difficult to time the market.
Mhm.
Okay. And so what we try to do is say, we're just going to be consistent year over year. And we believe in the real estate long term. So with that being said, how do I protect myself in a situation like this? And I was just talking to somebody before I got on this call. We're getting ready to do two of the biggest projects we've ever done.
Really?
And, we're a couple weeks from getting our loans, and, construction prices go up by 20%.
Yeah.
Well, just think you're doing a $20 million job and price went up 20%, right? And you start doing that math and you're like, oh, well, this is a huge problem, right? So how do we deal with that? So what we've taken the position of is, look, if you bought your real estate right, what you can do is we've recapitalized our deal and brought extra capital in. And for that, we've given up ownership. So we've taken the ownership that we've had and we've lowered it and said, look, what do I got to do here? I've got to be prudent. I got to make sure that my deal still has enough money in it and enough runway in it to get done.
Yeah.
Because if I wait and I'm wrong and inflation happens and construction costs continue to go up and interest rates continue to go up, well, now I'm sitting on a piece of land and I've got other issues.
Mm-hmm.
So what I want to do is continue to move forward, but protect myself. So I have two deals that I recapitalized with way more money into them to make them safer, right? And I think that a lot of people will want to either be paralyzed and do nothing, right? Or two, will lie to themselves and say, hey, don't worry about it. The price is going to come back down. We're already committed to this deal. Let's move forward, because they don't want to give up any of their ownership, right? Like, well, I worked really hard. I deserve this piece of the deal. And our position always is, look, we don't deserve anything. It's our job to serve our investors and our clients and the people that do business with us. Mm-hmm. And so what that means is if things go bad and I'm your development partner, you want to know that I'm taking more of the hit than you are.
Yeah.
Right. And that's what we do. We go out and we make sure that that's on us, as much as we can. And to date, it's worked well for us. And I think we've positioned the deals that we're doing going forward well. So, that's kind of our position on just development in general. And then you had asked the second question, which is, hey, let's talk a little bit about out sales versus rental and how do you kind of see those markets? Mm-hmm. So, I think the entry level out sale market is a tremendous market to be in.
Mm-hmm. And define entry for people who may,
Yeah. So great question. In the Philadelphia market for new construction, that to me is in the 400,000 range.
Right. I would agree.
And so if you can deliver product in solid neighborhoods, not all the neighborhoods that are taken off because you could never afford those, but a solid, like a Roxborough or Overbrook or a place like that, where it's just, it's a solid neighborhood. It's always been a solid neighborhood. Families want to live there. Those markets I think are going to do tremendous. And as much of that as I can do, I want to do.
It's interesting you say that, because I think that encouraged, like, since the opportunities are so slim as you get really close to where it's already developed, and it's tough to find like land or whatever buildings at the right price to be able to have an out sale at that number. Like, people are asking, I don't know that dollar per square foot numbers off the top of my head, but like, take Overbook, for example, like that's far enough out where, like, if you're in 19104, the dollar per square foot that people are asking there, people are trying to get 80 grand for lots that are 14 foot, and it just doesn't work for you to build a house and sell it for, a certain amount. But, that makes a lot of sense. Like, it's going to keep expanding into areas that are just a little bit further out and still great, C+, B- class neighborhoods, working class, not crazy dangerous, like, and still have plenty of room for growth, at least in a city like Philly.
That's exactly right. I mean, look, these are the neighborhoods. I don't know where you grew up, but that's the neighborhood. I grew up in Roxborough, right? And I know that neighborhood. and it's a great neighborhood, and I think that Overbrook is a great neighborhood, and
Yeah.
there's plenty of places where there's the opportunity to do these things and create great lifestyles and living for people at a reasonable price. And so, again, and one other thing, the other reason that's a great market to be in is, guess what happens if the market turns and rates go up 8%, go through the roof.
Right.
I can rent those properties and cover my payments,
Yeah.
right? So I can protect my downside. If that property is $800,000, I probably can't rent it for enough money to cover my mortgage.
No. It's like maybe you'll get $3,000 a month or whatever, but that's probably not gonna do it.
It's not gonna get it done, right? So people get frustrated with us a ton, Rodney, because we'll pass on so many deals because people think we're super conservative.
Mm-hmm.
But the reality is we're just trying to protect ourselves and our investors. And there's enough deals out there that are going to come in that meet our criteria. And we have a 15-year plan, not a 3-year plan.
Yeah.
So,
I mean, that's a very in-depth answer. And to close out that thought, just to make sure I understand what you're saying, basically you're doing, it sounds like you're doing a really good job at protecting yourself from a total loss, right? And when you say recapitalize and you're bringing in extra money to have for the rainy day or for when the costs go crazy, what that means is you've already probably put an amount of equity in yourself, and because I think a lot of people may be imagining so you put money in yourself and you're diluting, I guess the word would be like your return might go down a little bit, but you're protecting the whole project as a whole. Is that kind of?
So yeah, so I'm going to give you round numbers, but big numbers, because this will make sense and you'll think of it as from a development end, right? So the one building that we're talking about, its appraised value upon completion and stabilization when it's rented is close to $50 million. Okay. Our ownership of that was 30%.
Right.
Okay. And then 70% went to all the money that was in the deal.
Sure.
In our recapitalization of that deal, we no longer own 30%. Mm-hmm. We only own 10%.
Okay. And so that's a very big difference.
Yeah. 20% of $50 million is a lot of money, right?
Yeah.
And so most people are focused on that piece of it and saying, well, I'm giving up all this, right? Now, remember, there's debt against. It's not like you own all that without debt. But the point is, that's a lot of money. And if you look at it as, hey, look, this is all mine, and I'm not giving up anything that belongs to me, kind of like a sunken cost mentality.
Right.
Then you're going to get stuck in that deal because you're not going to have enough money to get the deal to the finish line. Right. So how happy are you if you're an investor in my deal and I say to you, by the way, Rodney, I'm bringing in an extra $5 million into this deal to cover all these overruns, and I took it out of my portion of the deal because I felt like it was the right thing to do. I need to protect you as my investor. I need to protect the deal as a whole. And so here's what we're doing.
Yeah. I mean, that's how you get lifetime investors. I feel like I'm sure you have people invest with you again and again and again because you're operating in a way not only are you keeping your incentive aligned, but like that's kind of like putting your money where your mouth is. I don't know if that's the right way to say it, but that's pretty awesome. And I didn't even think that. I don't think I've ever would have even thought of that. Maybe I would have thought of it. I haven't done something that scale, but it makes a ton of sense. And so one last thought that kind of ties into where I was going to go next for a second, and something you mentioned at the beginning. I've heard a lot of people when talking about returns and risk management and all that these days talk about apartment buildings in a way that's a little bit different than like how my mind processes it. They're comparing the difference in, like you had mentioned at the beginning, 3% debt, 5% return. And so you have a certain spread. And if it's on a larger building, right, it makes sense. Do you think that at some point, like I was talking to someone about this particularly like Northern Liberties, like Second and Germantown area, there's a lot of units going in there, like 1,000, right? Or something close to that number. And I was talking to someone that was telling me like, all right, well, the way I look at it, and they're still buying buildings in this market, like even though I'm buying something at a 4.5 or 5 cap, the debt is, the debt's 3% or 3.25 or whatever. Do you think it's dangerous, like as the cap rates are just compressing and compressing and they're getting lower and lower, like what if rents drop 4, 5, 10%? Like it's something no one really can predict completely, but like especially on a large scale, like when things turn and the economy shifts, like rents could drop. Do you think a lot of people are maybe getting too close to that line where they're like, yeah, 4.5 cap or 5 cap, and the spread's just getting thinner? I'm just worried that like a lot of people are things are gonna start folding when something happens, and vacancy going up 5% and rents going down 5 or 10%. That could wipe out all your profit at those kind of numbers. So you have any thoughts on like, is there a spread that you like to see for a certain asset class? I know this is kind of a particular question, but you get where I'm going. Like where's maybe a safe margin for someone to be looking at?
Mm-hmm. No, look, that's a great question, and it's absolutely the question you should be asking. Mm-hmm. And by the way, I own 2 buildings right in that exact area, one of which we just finished at 1018 Germantown, right? So literally right in the heart of where you're talking about, and it was only 50 units, and we rented it up right at the end of COVID, and it's 100% rented. But what I would say to you is, that ratio of how much spread do you have of income after you pay your expenses to your mortgage payment? What's a comfortable ratio? Well, the banks will lend you to the point where you only have, 20 or 25% more. So you have $12,500 in income and you have a $10,000 mortgage, right? So that's 25% more. We like to be 35 to 40%. Okay. So we'd like to have $14,000 on a $10,000 expense, which would then give me, some runway for, rents going down and vacancy going up, right? Because exactly what you said could happen, right?
Yeah.
So that's what we try and do. We try and be a little higher on those ratios than most people, so we can absorb that.
Okay. And in that example, the 10,000 number, that's your mortgage and all your expenses rolled into there.
Well, so let's do it this way: $20,000 in income comes in on the building. $5,000 in expenses, let's say, which are taxes, insurance, vacancy, maintenance, property management, all the real expenses.
Sure.
That gets you to what would be called a net operating income.
Got it.
Okay. So your net operating income is now 15,000, right? So you had 20,000 in rent, 5,000 expenses. So that assumes you have no mortgage. This is, I paid cash for the building. I got 20,000 rent, 5,000 expenses. I'm left with $15,000 in net operating income. And now you take your mortgage from that. So $10,000 mortgage, $15,000 in money and net operating income. You're a 150 debt service ratio.
Okay. Thank you for breaking it down like that. I think it's going to help a lot of people. Like looking at it from the beginning, from the gross, I think really helps. This is great. We're going real in depth here. I think the particular examples and breaking it down with numbers really helps, I think, drive some of the points home. So I think this video is probably going to be tailored particularly to like people that are in kind of like my position, like think single family, thinking about multifamily. That's really what I wanted to gear this conversation to. So kind of jumping into another fun topic, like asset classes, and let's just say asset classes. Do you think, so first of all, like size wise, like say you have someone, you have your typical investor that's investing into single family. And, I know for us, for example, we've been looking at, give an example, right? Yesterday, we put a property under contract in West Philly, right? It's a single family house and knock on wood, I hope this actually closes. Single family house on a 40 by 100 lot that's zoned RM1. Crazy, right? For less than $100,000. I'm like praying to God, I'm going to run title and close as fast as possible, because that's what I'm like, this is it. We might finally do this, right? So I've been looking for things like that, because I'm like, I don't know how to make this next jump. Do I look for a 5 or 10 unit like that to build new? Do I try and find a little warehouse, which I've seen some of, that you buy for 500,000, 800,000, whatever it is, and then rehab it, which might happen quicker because there's a structure there already? Like, so do you have any thoughts on, and you can say particularly in Philly or not, whatever, like the next jump, what's maybe a more realistic jump for someone that's making that move that's maybe not too competitive? Because I know as soon when you get over a certain size, you're up against institutional money, you're up against a lot of different things. But like, any thoughts on like what maybe, or even if you have anyone you know that like has made that transition and what they've jumped to, and multifamily, mixed use, industrial, like I know it's a pretty loaded question, but that's what we're trying to like weigh right now.
Sure. So look, hopefully this will make it simple for you, right? If I were going to jump from asset class, which we're going to call multifamily / residential, which would include a single family, to industrial or retail or office, the first thing I would do is, if I found a deal that I liked in that asset class, is partner with somebody that's already successful in that's a couple stages ahead of me, and do my first deal with them.
Okay.
Right. I'm going to take all the mistakes out of the equation. I'm going to give up a piece of the great deal that I found for the mentorship of that partner. Right.
Okay.
That's what I'm doing. So if you wanted to go from asset class to asset class, because there was a reason you liked a different asset class, that would be my recommendation.
Got it.
If you're talking about now, you in this specific example you gave, and by the way, if you're buying a 4,000 square foot lot, 40 by 100 in an RM1 zoning, which is multifamily with no parking in Philadelphia.
It has a curb cut.
Okay. With a curb cut for $100,000. That's the home run of all home runs. So get that thing closed, number one. Yeah. And then number two, building a ground up multifamily building there is the right move. And enough people that, can recommend the zoning attorney, they can recommend the construction contractor, right? Like, I can give you a list of people. Here's people I like that do all these different services. Go out and hire them. They will guide you through the process, right? So as long as you have the money you need to do it, I think you're ready to take that next step and move to that next piece. I would tell you that what's interesting is, I would tell you stay away from the warehouse and 100% do the ground up new construction.
Really?
Ground up new construction is 100 times easier than retrofitting existing stuff.
Okay. Good to know. Because I haven't done either. So I'm so used to the buy something, rehab it, refinance, pull most of equity out, like that wouldn't naturally, I'm like, oh yeah, we could just gut this space and there's already a structure. So I feel more comfortable somehow. But I guess maybe at that scale, is it because the process is more predictable and, you find more unknowns in a warehouse, or?
Yes, it's that. And then you have design layout constraints with an existing building that you wouldn't if you were building from the ground up. So it's certainly more expensive to build ground up than it is to retrofit an existing building, but maybe $25 a square foot difference. It's not what you think it is when you're getting into scale. When you're doing a single family, you might be better off rehabbing a single family that doesn't have any structural walls or anything they have to deal with.
Yeah.
But when you get to that next level, you definitely, it's definitely easier to do the new construction. So I would recommend that. And I think you'll find that the good news is the banks are going to help you underwrite it, right? They're going to want to see certain things. They have track records of people's performance for these things. They know what they cost. So even if you tried to mess it up with those things, the banks probably wouldn't lend you the money if you didn't have your stuff tight.
Yeah.
And so I think you would be fine with that. That sounds like a great lot. Sounds like a building that will definitely make money when underwritten properly.
Yeah.
And, my rule of thumb for that would be, put 30 to 35% in for expenses.
Okay.
Right. Which includes taxes and insurance. You're used to the residential side where taxes and insurance sit in the mortgage payment.
Yeah.
count them as part of your expenses and just count the principal and interest on kind of for the mortgage piece of it.
Okay. Well, thank you for that specific advice. Now, so speaking a little more generally, you think it's more realistic for someone like your average investor to maybe like find a deal like that and then partner with someone and just go for a new construction play like that? Like you think that's more not realistic, but like more you know what I mean? Like, is that easier to find when you're trying to make that next step, whether they're using their own money or not? Do you think that's you know what I'm saying?
I know what you're asking.
Yeah.
Look, I think that one of the hardest things to do is find good real estate.
Yeah.
Okay. If you find a good piece of real estate, you will know immediately, because when you make the phone call to whoever it is that you're calling to ask for advice or help, they're immediately going to say, Rodney, yes, I want to do this with you. Right. Like you will know immediately when that happens. My guess is that when you bought that and somebody was selling it thinking, hey, this is a single family house and it's worth what a single family house in this neighborhood is worth. And they never realized, well, wait, you can knock this house down and on 4,000 square feet, you can build 16 or 18 units by right. And so they sold their piece of property way under the value that it's worth because they considered it a single family house and you considered it 16 apartments. Right.
Be very honest. I didn't add the bonuses in. I was like, oh yeah, 9 to 11, but
still the same point. Let's just call it 10. They valued it as 1 unit. You valued it as 10.
Right.
Right. So you're buying it for $100,000. That's $10,000 a unit, and it's probably worth $25,000 to $30,000 a unit. So you probably paid $100,000 for something that's worth $300,000 realistically.
All right. Well, now I just answered my own question. I was going to keep the house on the portion of it and rehab it and then cut off the rest. But it sounds like I should definitely not do that and tear the house down.
I think you'd be better served to tear the house down. Yes.
Okay. Awesome. Well, this has been great so far. And we talked about taking the next step, finding deals. So you working on anything? I guess one of the last things I wanted to ask about is like, I know growing and all that, and I think you might have spoken about this on another podcast, like everyone's got their black marks or red marks, whatever you call it, their failures and losses. Do you have any good, like spectacular, like, oh my God, that you're willing to share, like a failure that you could share that maybe people can learn from and just understand like this kind of stuff happens to all people at all levels. And, sometimes it helps drive the point home, I think.
Sure. Yeah. Look, anybody that tells you that they don't have failures and every deal they did's a winner is probably, I'm not going to say lying, but probably just, is an eternal optimist that kind of forgets about the things that maybe went the other way. Right. Yeah. So, plenty of deals that I can tell you about that we passed on that ended up being home runs, but I'm going to tell you about deals that we did that you go, all right, well, you did this deal and now it didn't work out. Right. So what's that look like? So I'll give you a couple examples and I'll tell you how we worked through them. And none of them were ideal, but they're, look, the goal in real estate is 1, not lose money, and 2, live to fight another day. You never want to go bad on a deal. So whatever it takes to have that happen, you want to do. So we bought a building close to our office with the idea that it was an old school building and we had a daycare that wanted to go in the building. Mm-hmm. And so we were buying the school, the daycare was going to go in the building.
Got it.
And it was fine.
100% commercial or?
100% commercial.
Okay.
Think of it as like the grade school you went to when you grew up as a 3-story grade school, and they were going to buy this thing and had parking and they were going to playground and they were going to move in and we were going to have to do next to nothing. And the rent was great. And everything was perfect. Well, there was something wrong with their license. So we had a lease, like had everything done, but there was something wrong with their license because they were coming in, they were going to teach Chinese to people that wanted to send their kids to a school that had Chinese speaking teachers. Right. So I'm like, oh, this is a great niche. Like this is perfect. Well, what had happened was there was a problem with their licensing. So even though I had the signed lease and everything, I closed on the building, I couldn't get their license. So now I own this building that I already bought with the assumption that I'm bringing this tenant in, the tenant's not there.
Oh man.
So now what am I going to do? Right. Well, what do? We do residential multifamily. So I said, all right, well, these classrooms line up great for apartments.
Sure.
So we're going to go back to the township. We're going to try and get it approved for apartments. Takes a year longer because it's not in the city. So it's outside the city. We build it as apartments. The apartments are 100% rented, but the money that it made versus what it was supposed to make was not very good. Now, the good news is me and my partners had bought it ourselves. So we didn't have any other investors in it. And so what we did was same thing we always do, right? Which is, okay, now we were going to own 100% of this.
Yeah.
Well, now the math isn't as good anymore, and we need to bring dollars in. And we actually had created an investment for the employees in our company, and they all put money into the deal through their bonuses and stuff. Now they own that building with us because now we have more money into it. Now it creates cash flow. They're all making a check off it. We own it. It's in a great submarket. Ends up being a win. But again, gave up ownership in a building that would have been 100% ours to other people to put more capital into the deal because what we had originally envisioned for the space didn't work, right? And so what's happened to me is a couple times I've gone into the suburban markets thinking I understand them. I bought another building that it was a office building with 2 apartments above it, that it had another single story house that sat behind it. And then it had a lot that I thought I could build 6 houses on by right. And I was going to build 6 houses on it and sell it.
Okay.
Sell the houses one at a time. And I can put the 6 houses on there. I read the code wrong. And what happens was there's a driveway that gets back to where the housing is going to be.
Right.
And the driveway is only 14 feet wide. But code today is 24 feet wide.
Like fire code or whatever.
Exactly. So the only way to do it is to knock down the building that I own in the front that has a commercial tenant in it and a couple apartments. So now I'm sitting on this piece of real estate that I still love. It's in a good submarket and all this stuff, but I'm not making any money on it. Again, smaller deal that we did by ourselves. So I didn't have any investor money in it. But what I do is I'm probably going to have my money tied up in that deal for 5 years before I make a dime on it. Right. So the good news is we've been able to identify good pieces of real estate. The bad news is sometimes when I think I'm smarter than I am and I really don't do my research 100% right, I'll run into some problems. And so what we did, and you'll probably find this funny, is we said, we got to put somebody in place to make sure Gary doesn't make those mistakes anymore. Because I'm not a detail guy. I'm a vision guy. I'm a high level guy. And when you think you got it all figured out and you're not checking all the details, you're going to get yourself in trouble.
Right.
And so the good news for us is we got ourselves in trouble, but we didn't need that money to live off of. We were able to take money, and work our way through these deals. But, these are deals in 15 years. We're going to be happy we owned them. If we knew what we knew when we bought it, if we knew what we knew today when we bought it, we wouldn't have bought them.
Yeah, but you'll still, as long as you can pivot the right way, it's not going to be a total loss.
But it's 15 years, and I could have put that money into a different deal that made a ton better yield, right? So I don't want to sugarcoat the loss. They're bad losses because when people don't factor in opportunity cost. That money I have sitting in that deal for 5 years is money that could have been in an income producing deal and now is in a deal that's not making any money. Well, that stinks, right? Like that's terrible. You don't want to do that. But it happens.
Look, it's happened to us. Houses that I'm like, oh man, it didn't get appraised for as much as I thought it was going to be. And oh God, we didn't got a little bit less rent than I thought. And then, oh man, we pay a little bit higher on the mortgage than I thought. And then all of a sudden there it goes. There's everything. Yeah. There's the profit.
That's right.
Oh, I'm going to sell it and walk away with $10,000. What do I do? Do I hold on to it? I didn't get enough money out. So, oh man. Well, those are very good examples. So thank you for sharing that. So what's next? Like what I know, it sounds to me from knowing you a little bit, like the exciting part of the business for you is actually like continuing, because you have enough properties now where I'm assuming you don't really necessarily need to continue to work as many hours as you do. So what do you see in the future? Like, do you have anything exciting working on with how your business is set up, growing your team, like different larger properties, or what do you have going on these next couple of years that you're looking forward to?
Well, I'm the number one thing I'm looking forward to is replacing myself, right? And
Okay.
so I get to work in kind of a visionary role within the company, and have the people that have been at the company for a while come in and take over the day-to-day operations of what we do. And
Mm-hmm.
so we're focusing on that now, and that's the goal. So I'm leaving to go on a bike trip across the country that starts in a month, and so we're
Awesome.
going to see how the team does. So
How long are you going to be? And by the way, if you could tilt it down a little bit.
sorry.
Yeah, that's perfect. How long is the trip going to take?
The trip's roughly 45 days.
Nice.
So it's going to be a lot of fun, and it's turned into a fundraiser for Big Brothers Big Sisters, which is an organization that I'm very fond of and on the
Awesome.
board for them. And so we're calling it Mentoring for Miles for Mentoring, and we're going to go out and raise a bunch of money for Big Brothers, and
Cool.
hopefully have a great time.
I'll put a link to that in the signature just in case people haven't heard about that. I'm involved in a similar one, Philadelphia Futures. Very similar concept. I've had a mentee for a couple of years. Okay, so bike trip, looking to replace yourself. If you focus on more visionary, I guess vision for the company, right? Awesome.
Yeah, I mean, I'd love to spend my time figuring out ways to be innovative within the residential space. Where are the next great things coming from, versus kind of more of the blocking and tackling and running financial analysis and that kind of stuff, which
Yeah.
I love a good spreadsheet as much as the next guy is what I say, but maybe some of this other stuff would be a good spot for me to be. So
Cool. And where can people find you online if they'd like to get in touch?
the best thing to do is just email me, Gary, Gary, at howgroup.com. So Gary@howgroup.com.
Got that. We'll put that in the show notes as well. Gary at howgroup.com. All right. Well, this has been very, very, very insightful. I literally have 2 whole pages of other questions that I could ask, but I want to be respectful of your time. I really, really appreciate you taking the time to share some of this. It's like very good, specific examples that I think really are going to help people understand, certain types of investors understand like how to really get through some of these next steps. So I appreciate you sharing all this information with us and always being an open book, with the good and the bad, and hopefully looking forward to do this maybe again, maybe in a couple of years at some point. And you may be in a completely different spot. I'm looking forward to seeing that and where you're going to grow into. So thank you again, and good luck with your next meeting, and I'll talk to you soon.
All right, great. Thanks, Rodney. Thanks for having me.